Hey folks, welcome to Pro Trader Strategies. My name is Eric Wilkinson, and we're here to teach you guys a little about the markets and ultimately how we can implement options into a portfolio based on those assumptions we come up with in our market analysis, or just if you have a directional assumption whatsoever. And this is a great strategy for smaller accounts, folks. If you are struggling with a smaller account value, less than $100,000, let's say, it's hard to build a balanced portfolio with a smaller account like that, unless you're using options. And I'm going to show you one of these ways, these neat little tricks using options, where we can save on margin by using these options, more so than even going and buying the stock. And they say it's more risky. I don't know. We'll see. I'll show you how it isn't any more risky. As a matter of fact, your return on investment is much better with this strategy. All right, so without further ado, like I said, let's talk about, if you guys want to learn about options and or just the markets in general, how the levers and pulleys are working, please hit that subscribe button down there and make sure you click on the bell so that you get notifications. I do daily market commentaries or market commentaries in the morning where I'm talking about my trades, but I am known to pop in at any given time throughout the day when I find a trade or I'm taking off a trade that I'll pop on live for you folks to go through it. So if you want to check that out, make sure you guys hit that subscribe button and the bell to make sure that you guys get that notification. And throughout this webinar, if you guys want to comment, throw it over there. I am going to be making sure I'm checking that and making sure you folks are clear of concept before I move forward. So please don't wait to the end. If you have a comment or a question, I'll throw it. I'll reply to you over there on the side. And I'm going to swing back around for some of you folks that are watching this on tape delay to make sure that you're clear concept too. I'm not going to leave you guys out of it. Finally, smash that like button for me if you would. It really does help us out. All right. So my name is Eric Wilkinson, and we are going to be talking about swing trades, specifically how to spot those swing trades, and then how do we find an option strategy that fits that market movement. It's not just going and buying a call for a bullish move, folks. What we do is we look at the underlying. I wouldn't want to buy something when it's super expensive, right? Well, that's the same thing that happens here in the options. You want to buy them when they're cheap and sell them when they're expensive, or sell them first when they're expensive and buy them back when they're cheap. That is ultimately the game plan here, all right? So we'll try and follow through with that as we're going along. First, let's talk about swing trades. What are swing trades? And ultimately, we're going to lead down to the road for bearish moves, all right? We've already done the bullish moves, so now we're moving on to some bearish moves using options. So if you're not familiar with some of those other ones, please check those out as well. All right, so let's get on with it. Swing trades using options. First, we're going to talk about, actually, let me get back to this. We're going to talk about the synthetic short later on, but first I want to talk about a swing trade. What is a swing trade specifically? Actually, a swing trade is anything that is going to last longer than one day. A day trade is something that you would have gotten in and out of today. A swing trade would have been something that you got into today and you're going to get out of tomorrow or sometime in the future. So a swing trade lasts longer than 2 days, basically, or goes throughout 2 days. All right. So ultimately, what you want to do is look for, calibrate your pen. I do not want to calibrate my pen. We want to try and discern whether or not this underlying is in a bullish pattern or a bullish trend, like an overall trend, like for the entire year, it's been moving higher, right? Or has it just been trending sideways? And finally, there's also your bearish trend, right? So we've got all three: a bullish trend, a bearish trend, and a market neutral trend, right? That's the first thing you want to do when you're looking at a swing trade. Kind of look at it with a glazed eyes and see where the overall broader picture is. And then what you want to do while you got those eyes blurred is then look at where it has a tendency to lose momentum to the upside, and that is where your resistance is. And then where it starts gaining buyers is where your support is, okay? And that is usually where institutional investors and retail traders are noticing these levels based on the overall trend and finding those support and resistance levels. And you can find it on market neutral. Ultimately, you want to do the same thing there and on a bearish trend. And then what we try to do is notice what the pattern is within the overall trend. So here we have a bullish trend, with a small little bear pattern in there. And we are going to base our trade on the pattern, folks. So we are going to be looking for the market to bounce off of a support or a resistance and then start changing direction. That's where you set your trade up on, all right? So here, bearish overall trend with a bearish pattern within it, okay? It's not always bearish pattern, bearish trend. That's not always what we're looking for. We're just looking for the overall trend. Find the trend is to find those support and resistances, and then look at the pattern within the trend and see if we're starting to see some momentum shifts here. Does that make sense for everybody so far? All right, so simple concept. I'm trying to build, what I do in my webinars is build from simple concepts to real life examples here, folks. So let's go on to a real life, there's our simple example. Let's look at a real life example. And this is an older snapshot of IBM because, you know, it fit the bill here. And we can see, if you blur your eyes just a little bit, you can see that this market really didn't go anywhere, right? It's a sideways trend, market neutral trend here. And then you can go back and start looking at the market and look at it kind of doing something like that, right? All right, so ultimately you can kind of blur your eyes. You're going to see a resistance area and a support area, right? I mean, you can kind of see that when you blur your eyes. It's a little bit easier when I throw it in there too. And it happens to line up with some Fibonacci's that I have. But if we go and look at this overall sideways trend or market neutral trend, let me try and erase some of this a little bit. Oh, I didn't want to erase all of it. All right, I was just trying to get off a little bit of that. So ultimately, let's go back to this because I want to go back to, that's not a very good one because I want to get right to here. This little candlestick right there, that is something we look for a pattern reversal, okay? So I'll throw up a couple of different ones here real quick. You know, you want to look for candles that look like this at the top of a move, like this, not in sequential order, right? These are separate ideas, all right, at the top of a move. This is another one that's like a tombstone, but ultimately, and they can be green as well, right? It doesn't matter if they're red or green, but if they look like that, where they have a base at the very top and then a long wick, that's called the hangman doji. This is more of a hammer doji right here, and it doesn't matter if they're red or green. Those are signaling momentum shifts, and we've gotten one right at the top of that move. That's where we're looking for that pattern reversal. Now, I am a person that has a higher risk tolerance, and I look for the setup bar. I'm not looking for the confirmation. This is the setup bar, and then we have a confirmation bar where it lines up right next to it. This is the confirmation, all right, of a reversal in trend. I usually get in on the setup bar, but if you are newer to trading, especially options, make sure you wait for that, the confirmation bar. If you're a little bit higher risk tolerant person, maybe look for that, the candle at the top of a move. It's not in the middle of a move like what you're seeing. Like there's a little one right down in there, if you can see tucked in there. That would not be one that I was looking for a reversal in the pattern, okay? I want it to be coming up close to where the support area, or sorry, the resistance area in this case is, in order to start looking for my pattern to start rolling over. In this case, that fit the bill quite nicely. So that's really what you're doing with swing trades, is you're trying to identify where, and you're not always going to be involved in this trade, right? It's not always going to come close to where your resistance is. It's not always that cut and dry, but there are opportunities. Like in the last year, you could see that it came, you know, for IBM, there were several opportunities where it came very close. Probably wouldn't have taken this one there or this one. That's not really close enough, but this one definitely. This one for sure, and that's just on the resistance side. On the support side, you can see there's all kinds of opportunities. This one would have been a bad one, but this one would have been a good one, right? And you could see that they found those support levels. So those are ideas that we're looking for when we're trading these. All right, that makes sense. All right, what happens though, right? We can see that that was a sideways trend, maybe a topping pattern looking like it's getting ready to roll over. And then all of a sudden it'll start trading that way before it starts coming back down, right? Now, if you get involved in something like this, usually with a stock, that market starts moving against you, it can hurt painfully. Now, I also talked about all of these other webinars where we're using options to get better strike location. The same thing happens with this strategy. I'm going to show you how we are able to get better strike location many times, or our purchase price is better, or our short price is better than what you would have been able to do in the open markets. And that's part of the beauty in these options as well. And I'll show you that come to fruition when we get down to the current examples. But this is why we're using options. For one, it allows us a little bit more wiggle room to be wrong. Like if I got involved right here shorting stock, but I was able to get involved here by doing the option synthetic short, well, you know, there's a lot, that's quite a bit of difference in how you would feel putting on this trade. You're still putting it on at the exact same point in time when the underlying's trading right here. But I'm going to show you when you're shorting how you could get your strike location slightly higher than where even the underlying is trading. But not to say that it won't do this. It will happen. Keep in mind, though, more times than not, if you're playing this often, it is going to be where you made these 4, 5, 6 times, and then one time it's going to go against you. And generally speaking, you're going to be right probably about 30-40%, or sorry, wrong only about 30% of the time. The other 60% of the time, 60-70% of the time, you are going to be a winner or a scratch because it's going to follow those support and resistance areas. All right, so this is an example of where it came back up and hit this major resistance area well above when we got involved in this type of trade. Now, there's some earnings in here and that caused that to pop, but you can see that that area of entry was very good based on those support and resistance areas. So you could have made some money on this. If you held it way too long, it probably would have come back to haunt you on that earnings. All right. So quickly review. How do we swing trade, right? What's the first step, folks? Throw it over there in the comment box. Who's got it? What's your first thing that you're going to try and do when you're setting up a swing trade or discerning a swing trade? Identify the trend, right? And then our next step, once we figured out that trend, kind of blur our eyes a little bit and try and figure out where that support and resistance is. And then finally, the pattern. Is it starting to roll over? If you are a newer trader, lower risk tolerant, wait for it to get confirmed, right? Identify the pattern. We're saying you're looking for candles like this at the top of a move, and then a confirmation. That means basically the next day you get a pretty solid down day for a confirmation of a downward move, right? Pretty solid confirmation, and it's going to finish at or below the previous day's low there. All right, so that's an easy way to kind of start conceptualizing candles. Now, those aren't hard, fast rules, folks, on you having to have that, but this is the kind of situation you're looking for at the top of a move. And like I said, that candle could be green at the top of a, why didn't you give me a green one? That candle could be green at the top of a move, right? It could end up like this at the top of a move, right? But you would still then be looking for that red candle confirmation, all right? Still looking for that red candle confirmation. These two are the same, okay? They mean the same things. It means that is a top with a confirmation there. All right? So I must be on delay for you, Jeff. I see you threw it over there. Trend, that's right. Jeff threw the trend. There is somewhat of a delay here, and I don't know how much it is. And why are we using options? Because you have better odds. Better odds of success. All right. If you have better odds of success, that allows you to keep your powder dry. your powder dry. Whoop, powder dry. What does that mean? Keep your powder dry. You're not sweating it out. You're not angst all the time. If you know your odds, you know the probabilities, then you are going to be able to stay in these trades longer. I say that it will help you keep mechanical. If you know what the levers and pulleys are doing, then it will help you stay mechanical. I was just talking to somebody the other day, and he was trading a stock right around earnings, and he couldn't understand why after the earnings he was correct. He bought a call after the earnings, the market moved higher. It wasn't a massive move, but it moved higher, and he lost money. And he just didn't understand the levers and pulleys. I told him, you got involved, you bought these calls when they were super expensive because nobody knew what was going on. So there's a lot of uncertainty. After that earnings, there's no uncertainty. And all that volatility came out of that premium, and he lost money. And he just, so when you're a newer trader, make sure you aren't getting yourself set up for a disaster like this gentleman did. Volatility crush. That's right. That's exactly what we used to call it on the floor. Volatility crush. When that volatility comes out after the earnings, that is what is going to cause those premiums to fall out of bed. Your movement, the premium increase from the directional move, isn't enough to offset that volatility crush. All right? Because it's going to come out so fast that you won't be able to, you're going to wake up the next day after the earnings has been released and there's no more uncertainty. It's all gone. Okay. All right. So in this, right, we've got pretty much a bullish trend here, right? Well, inside of there, it was trying to set up for a bullish pattern within that trend. But remember, I said, do not look at that candle right there. Sorry, I've got two different pins going on. Some of them erase, sometimes they don't. Erase that ink. Erase the ink. I don't know. Oh, there we go. So what I'm talking about is that candle right there. That's that hangman doji, but that's not at the bottom of a move, right? Or at the top of a move. So those are the ones that you're going to want to discount. You're not always just looking for that candle. It needs to be somewhere like, on the hitting on these supports. Like that's a perfect example of one. And the confirmation right next to it. All right. So again, market neutral, right? We can see there's one of those candles. That's something you would look for. Bouncing off of that support area, right? That would be an opportunity. But you can also, again, see we've got a market neutral, right? And it looks like market neutral. You can kind of see the resistance support areas, right? And we bounced on a support and we've gotten one of those candles. That's what I would be looking for on setting up a trade. So yesterday, if you guys were watching the daily market commentaries, I've been talking about this for a couple of days now when we were getting this setup. Now, Nvidia was doing this several times, like right there looked like a good opportunity, right? At the top of the move. It didn't get confirmed. Now, generally speaking, I would be one to jump on one of those. But, then you start getting these stacked up, right? We're getting those similar. We get a hangman doji, a spinning top doji. Spinning top doji, folks, is just one that has like a bit of a wick at the bottom of it. So it looks like a spinning top. So when you start seeing those stack up, especially after a parabolic move like that, you know that the momentum is starting to slow. Think about it. If you got involved in this rally, how anxious would you be to get out of this trade, right? You'd be looking to get out. So that's when you start seeing those stack up. That's a good opportunity to look for the market to confirm. And as you can see, yesterday we got the confirmation candle. I got in a little bit early. At the end of the day, it was definitely confirmed. But again, I get in a little bit early. I didn't get in on the hangman, but I did get in as soon as that bearish candle started happening. It started looking like it was going to engulf, which means basically you start out the day a little bit higher, and basically the entire candle engulfs the previous day. Now that's another serious bearish pattern, an engulfing pattern. So I started looking at, all right, this is a time to take advantage of some negative deltas, right? I want to add some negative deltas, which means I want to short something. I want to add something to my portfolio that when it goes down, my P&L benefits from it, or my portfolio benefits from it. That's negative deltas. If you have negative deltas, you want the market to go down, okay? So, and you know, I always talk about this. That's the best way to hedge your portfolio, is to add negative deltas to it somehow, some way, all right? In this case, I'm adding Nvidia as negative deltas. Now, had I gone out there and shorted this underlying, it would have been a headache. I would have had to pay maintenance costs. I would have had to pay margin. I would have had to pay the dividend. Okay, so all of those things are a pain when you're dealing with shorting. And that's why you don't hear very many retail traders like you and I shorting underlyings. It is a massive process. But if you are to go in here and do it with options, I can create the same situation as shorting the stock, okay? By building it out the way that we're gonna talk about here in just a moment. But this is a swing trade setup that I'm going to look at for today's video. Hold on a second. Sorry. I'm changing the screen in the background, but I forgot I locked it down. All right. So now we're going to talk about options. We talked about the swing trades, what we're looking for, you know, specific those. I really like, if you're a newer trader, look for those candles that I talked about, the Hangman Doji and Spinning Top Doji a little bit, but Hangman Doji and the hammer. The hammer looks like that. Okay, so those are what you're looking for at the top of the move. Whether it's green or red, it doesn't matter. All right, so what are options? Now, if you're thinking about options, a call buyer has the right, but not the obligation. Not the obligation is key to buy the stock. So, for instance, if we're looking at XYZ stock, let's just use XYZ stock as an example, and let's just say it's trading at $100 even, okay? So I can go out in the market and buy stock for $100, all right? Now, as a call buyer, I can buy any strike I want. I could buy a 90 strike, I could buy a 105 strike, I could buy a 110 strike, okay? But let's just say, for this example, I'm going to buy a call at the 105 strike, 105 call, all right? So that call is above where the underlying is trading. And now let's go back to the definition. A call buyer has the right, but not the obligation to buy the stock. So if I buy a 105 call, that means I can buy the stock at $105 anytime I want. I can do it right now. Would you want to do it right now? Would you want to pay 105 when it's trading 100? No. So you would not, you know, do the obligation. All right. You're not obligated to buy it at 105. So you would just say, no, I'm not going to. But now if XYZ went up to 150 and you still own those calls, are you going to want to buy it at 105? Yes, there's an immense value. If I can buy it at 105 and it's trading 150, there is an immense value in that option, and it will be reflected in the price. Okay. Now, if you are that seller of the option, you have the obligation to deliver the stock. And it doesn't matter. I mean, if it's trading 100, if the underlying is trading 100 and I'm short a 105 call and that dude goes, hey, I want to, you know, what is it? I want to execute my right to buy that stock at 105. I would have to sell it to him. Now, that's a situation that is probably never, ever going to happen. I've never been lucky enough to have that happen. But it could. It's not going to, because nobody in their right mind is going to pay higher than where the underlying is currently trading. It just never will make sense. All right, a put buyer has the right but not the obligation to sell the stock. All right, so if I buy a put, that means if I pick the 95 strike, let's say the put was we'll do a put at the 95 strike, right? Now, that gives me the right to sell the stock. If the stock's trading 100, am I going to sell it at 95? No, I hope not. You're going to sell it in the open market at $100. All right. Now, if it goes down to 0, am I going to, say, hey, dude, you can take my stock at 95? Absolutely. There's a huge value in that. All right. So think about it from those perspectives. If it's at 100, I'm not going to sell my stock below where the underlying is trading. It just doesn't make sense. So a call buyer, call up. A put buyer, and this is the R for put on the floor, we used to say you put down. So you call up and you put down, all right? So puts, you want to go down for the buyer's perspective. And if you are a put seller, you're selling puts, that means you have to buy it, okay? If I sell that put and the market goes tanking, I have to take delivery of that stock. Now, when you are a seller, though, you get paid for that risk, right? The buyer is paying you for that risk, right? So you can think of it like you and I as insurance buyers, right? You're buying insurance on your house, right? Well, they're selling you insurance on your house, right? Your premium that you're paying out is the same thing as your premium you're paying out in your call. It's giving you protection. And the seller is kind of like your insurance company. They know the probabilities are in their favor, so they're willing to do it. All right. Now, I know the SEC and everybody out there says that it's too much risk to sell options. Now, I don't know. Insurance companies seem to make a lot of money. Yeah, not many insurance companies go to belly up. All right. So, options prices. All right. We talked about those prices. You buy them, you can sell them, right? There's a premium that we're transacting. But what I need to know is that 105 call that in our last example expensive or cheap? Is there 105 or 95 put expensive or cheap? Well, we have to go over to we have to look at this underlying to figure it out, right? So what we want to do is volatility. Now, some people will say theta really determines the options premium. Well, in a sense, because more time, you're buying more time to be right, okay? So if you're buying a longer duration, you have to pay more for that time, okay? It's kind of like if I paid insurance for 1 year, I got insurance for 1 year, and it cost me maybe $100. If I bought it for 2 years, maybe it's $150. 3 years, it's $200, whatever. But I have to pay more for that duration, okay? For that longer risk, all right? And Vega is the thing that tells us how expensive or cheap the premiums are. And Vega is just a fancy word for implied volatility. I'm just going to rate ball. It's implied volatility. And implied volatility, as it fluctuates, right? You've heard of volatility, the VIX. This isn't the VIX, but as volatility fluctuates, we will see these premiums go up and down based on what volatility is doing, or Vega, all right? So Vega determines on any given day the options premium, all right? Theta is already in there for the premiums, but theta is never going to make the premiums increase, all right? Delta is never really going to make the premiums increase. The underlying is going to go higher. Delta is going to follow it, all right? Delta is going to track it. So it's not necessarily the same idea here, where the underlying, this could not move a penny, and if volatility moves up and down, we will see our premiums move up and down, all right, at any given second. So for Nvidia, I need to determine whether this number 4344 is high or low for Nvidia, all right? Now you're going to see when you flip through different options or different options montages, which is this page, like if I go over to Tesla, all right, right now, I would probably not see a 43 in Tesla, right? It never gets that low. So what I have to do here, folks, is compare, let's just go to Tesla. I have to compare apples to apples, right? So it's about, I mean, we're talking about Nvidia being an $800 stock. This is around a $700 stock or $650. So we can talk about the volatility. And, you know, sure enough, they catch me wrong. 44 is showing there. But if I go over to the charts here, and I'm going to have to pull up Implied. Actually, let me do this. Let me get out the one that has the better premiums. What was I looking for? Apple, right? Wait, I lost my train of thought. Oh, Tesla. All right. There we go. All right, so let's blow this up. All right, so Tesla, we're looking at, there's one where it's 43, but let's go over to the chart. So you can see Tesla, the real low for implied volatility here is right around 56. So when we're looking at Nvidia at around 44, we have to compare Nvidia's implied volatility against Nvidia's implied volatility to determine whether the premiums are expensive or cheap, because they all have kind of like what we were looking at in that swing trade, right? The idea that there is going to be where a resistance area and a support area, right? We can see that on those charts. So we can determine if those premiums are expensive or cheap in my IRA. All right, so therefore, what I want to do is then go over to the same chart that we're looking for in Nvidia and look at this implied volatility chart down at the bottom. All right, and I can see 44 is right there. All right, so you can kind of ballpark it. It's kind of like right in the middle of that chart. If I look at it, blur my eyes a little bit, right? See the resistance areas, find the support areas, okay? And it's kind of right in between there. So the idea really is to buy, you know, when it's real low and sell when it's real high, right? Well, I've got a little bit better idea for you than just spitballing here. What we want to do is take a look at it. And what I do is I've discounted everything from last year, okay? Because we had super high implied volatility. I mean, like we changed volatility paradigms for a year almost. But I don't think we're going to see this kind of volatility. So I want to not really look at it, that data, all right? But I can see, you know, there is basically a resistance area, and this is the support area, right? And currently right there. What we do is you take the current implied volatility. This is how you get implied volatility percent, which is what Thinkorswim does. I have the script to only give you back 6 months. They give you a script for a full year. I have the script for 6 months. I'm only looking 6 months back now. Okay, so you take the current minus the low, and you take that sum and divide it by the high, implied volatility, minus the low. Now, you don't have to go through all this math. This is for people that really want to dig into the details, folks. I'm going to show you a quicker way here in a minute. But if you really want to look at it, if I look at the current, and I'm going to discount this 67 up there, because if I do that, it's basically a 44% if I use the entire range, okay? But if I use the current right now, which is 47, and subtract it by the low, which is 31, I'm going to say. And then we take that by the high, which I'm going to give it as 54, minus the low, which is 31, okay? So basically, we're trying to get where this is within this range in percentage terms, okay? So I've got 4. Oh, this is not 4. That's 16. 16 divided by 20, what is it? 16 divided by 23. All right, and that's going to give us about 69%, all right? So it's in the upper half. So when I'm talking about like in this, I would say this is a sell zone and this is a buy zone, right? Above and below that 50 line. Here, you know, it's, above and below 50%. Right? It's above 50%, you're selling. It's below 50%, you're buying. This one's giving me a 69. If I use the whole range, though, it's giving me a 44. I don't think we're going to get that kind of volatility, folks, so that's why I'm discounting it. But it's giving us a real mixed bag here on, I said you want to sell above 50% or buy below 50%, right? Well, if I do the math one way, it's 44. This way, it's 69. I'm leaning towards the 69 and it being higher. But I'm just saying that you could get a discrepancy like that. So, we have a bit of a conundrum then in that case. Just know, though, generally speaking, if it's above 50%, you're selling. If it's below 50%, you're buying. In this case, we don't know if they're really cheap or if they're expensive, right? Volatility could be going higher. I've gotten that pattern in the chart setup where it looks like we're going to start selling off. And usually when you start getting a sell-off, you get volatility going higher, okay? So I've got a bearish directional assumption. So you're always thinking volatility might creep higher on a bearish assumption. Just know that as a given kind of thing. More times than, like a lot more times than not, it will increase as the market comes down because people are going out and buying protection. And when they're buying options with no regard, then they drive the prices up. All right, and that's where we see volatility increase. So with all of that said, are they cheaper? Are they expensive? I'm going to say they're right in the middle, and I want to hedge against that volatility. All right, I'm not quite sure why my page won't. All right, so I want to look to hedge that volatility. All right, and if I'm hedging the volatility, then I don't have to worry about that, but I still have this thief in the night, theta, that other Greek. And the way to remember theta is just remember, it's the thief. And it comes in, steals premium, but it's not linear. It's not $1 every single night, or it's not, 50 cents every single night. It's basically, it starts out, let's say it's $1, and then the next night it's $1 and change. The next night it's, $2. The next night it's $2 and change. So it's slowly increasing every single day, okay? That's what's happening in the options. It's not just $1, $1, $1. And if we look at it this way, you can see that the options, the decay on these options is, it starts ramping up, right? You can see it starts really getting aggressive inside of 35 days to expiration. Now, one of the beauties with this strategy is we are not only hedging volatility, we're hedging theta, all right? Because I'm going to be buying an option and selling an option in the same month. And therefore, let's just say, since the reds, the calls, and the blues, the puts, if I am selling a call and I'm buying a put in the same month at the same strike, you can see that they're going to offset one another. The short calls, they're going to go down in value. That helps. The long puts, they're going to go down in value. That hurts, but they are going to offset. All right. I'll show you that here in a moment. So if I can offset all of the volatility and the theta, I want to be able to get out here in time so I give myself more time to be right. I don't have to worry about theta decay. It doesn't have to happen right now. I may be doing this for a swing trade. I think it's going to happen in the next 1 or 2 days, but I still want to get out in time in case I want to play this out. It gives me more time to play this out, and it's going to cost you the same amount of money if you did it in 45 days or up to about 90 days. If you go out 300 days, it's going to be a little bit different. But, basically inside of 3-4 months on a swing trade, I don't know very many people that hold on to it longer than that on a swing trade. So the thief in the night, we've kind of offset that, but I want to, or we will offset that. But one thing I want to show you is inside of that 7 days. Remember, we showed you in that last thing right here, this 7 days to expiration, you really see theta go bonkers. All right. 35 days to 7 days, you lose 50% of those premiums, generally speaking. So out in time, we see that a little bit less. So we can see this show up here in this table. So I'm just going to look at the calls. Theta is always, actually, let's look at the calls and inputs. Theta is always negative. You can't go back in time. All right. So everything with the options is an advancement. You know, it's assumption the underlying moves higher. A day goes by. All right. Volatility increases. Right. So all of the numbers are based on an increase. You start getting decreases, you have to add that negative coefficient to it. All right. Like we can't go back in time, so we don't add a negative coefficient to theta. All right. But what we can see is basically, you know, from 100 to 72 days, it only increased by about what? 8 cents. And then basically from 72 days to 44 days, we get a little bit more increase, and that increases by about 14 cents. So it's doubled to there. And then 44 days to 9 days, look at that, it's doubled again. So you can see how that really starts ramping up. And generally speaking, when you're buying, if you're just buying an option, this is the wheelhouse I'm looking for. But because I'm in a situation where I've offset all of these things, I might as well go out there. All right. So default outside, you know, we want to get into those basically 70 days to expiration is kind of the sweet spot. All right. So let's go back to this strategy and why we're choosing it. I've got this where it's hit a resistance. There's no real resistance here, but I can see we've had a massive move. I'm looking for a correction. And as a matter of fact, when I talked about this in the daily market commentaries, this was kind of the spot I was looking for where it came up. That would be the resistance area or support now. All right. Another one is kind of like right here. And we actually popped below this $80 today. This was snapshot yesterday when I put this trade on. All right. So it was like, as soon as I did it, I started taking snapshots based on that. You know, I'm not cherry picking this, folks. I don't cherry pick trades. I talk about the winners and the losers, even in the daily videos. So I'm not just going to try and cherry pick something. I'm going to, hey, this is what I see. This is why I see it. And this is what I'm doing. And with this trade, I've got volatility. I've talked about it. It seems pretty high. It leads me to thinking I want to sell options, right? Because I've got that high implied volatility. I know premiums are expensive. But I also talked about this. I've got a confirmation. If I start really seeing a correction here, what we usually see is volatility has a tendency to start creeping higher. So if I sell something and that volatility creeps higher, again, I could see this market roll over and it not making any money because that volatility increases, right? If I have a short call, I want the price to go down because I'm short a call. You know, I would have to sell the stock there, right? So I want it to go down. And if I want it to go down and I sold a call, I want those premiums to go down. But if volatility offsets that directional move, that hurts me. All right. So that's what I was talking about. I want to hedge this volatility. I've got a bearish directional assumption with high volatility. That leans me towards 99% of the time doing a short call spread or something like that, maybe a bearish risk reversal. But this one is such a beautiful setup. I decided to be a little bit more aggressive with this and do it just like I'm doing a short stop. So yesterday, I decided to go into the options and build a synthetic short position. And with that, let's talk about delta. Now, delta tells us the rate of change in an option, okay? So usually the further in the money an option is, it will get closer and closer to 1. And what 1 means on a delta, or 1.0, means is when the underlying moves $1, those premiums will adjust by that dollar. Meaning if the underlying moves higher by $1, my calls that are in the money that are very close to a 1 delta will increase by almost $1 there, okay? So if I have a 50 delta and the underlying increases, if I have a 50 delta call and the underlying increases by $1, how much does my premium and my options go up by if my delta is 50? Right? If my delta is 50 and the underlying increases by $1, how much does my call increase by, that 50 delta call? 50 cents, that's right. So it's half of that. All right. The other thing is it also tells you the odds of your option being in the money at expiration. I watched this guy the other day talk, and he basically was saying delta tells you the probability of your option being in the money during the life of the option. And that's not true. It is the probability of, that's right, Jeff. I gotta get on this tape delay. Jeff's all over it. The probability of being in the money at expiration. Okay. But remember, calls, the delta on the calls, the call delta is positive. All right. And the put delta is negative. All right. Always. So it's like if the underlying moves higher, my calls will increase, my puts will decrease in value. Right. Now, what happens when I sell a call? Let's say I sell a call. Well, if I sell a call, then a negative plus a positive makes it a negative, right? So it's, my position is negative deltas. So I need to make that underlying go down, right? Now, if I sold a put, a negative plus a negative is a positive to my position, right? This equals a negative and this equals a positive. Okay. So ultimately, you sell a call, it's plus a positive, makes it a negative. Sell a put, it's a negative delta, that makes it a positive. Meaning, if I sold a put, I want a negative plus a negative makes it a positive. I want this underlying to go positive, right? Negative plus a negative, I sell a negative delta. That negative plus a negative means my position will benefit from a positive move. Everybody with me there? And I sell a call, I sell a positive delta. I'm short, negative plus a positive makes it a negative. I need the underlying to go down. All right. Now with this strategy though, we are going to be doing this where we are doing the same at the money puts. I'm buying negative deltas, right? And I'm selling positive deltas. So I'm looking at the 50 delta options, okay? So I'm looking as close to a 50 delta option as I can, all right? So if I have, the puts are, let's say 50 negative deltas, right? And this is 50 positive deltas. If I am long an at the money put, I'm buying negative deltas. So that's basically negative 50 deltas, right? Buying 50 negative deltas, positive plus a negative is a negative. And then I'm selling 50 positive deltas. So a negative plus a positive is a negative 50 deltas. That means I add up to 100 negative deltas, right? If I sold 100 of the underlying, if I sold 100 XYZ, that's 100 deltas, right? Because for every dollar the underlying moves down, the position moves down by $1, right? So that's 100 deltas. The stock is 100 deltas. We do this by building it out. And it's not always going to be the same thing. It could be 52 and 48, okay? You could have something like that to get you to 100 deltas. And as a matter of fact, this is the one that I would encourage you to do, because then you're buying the put that's in the money and the call is slightly out of the money when you start. Just to help you keep your powder dry. One of those little tidbits that, you don't want to have to worry about it being in the money, the shorts in money and all that stuff. I get it. So set it up that way. So with that said, I don't want to look at these options, right? I'm not going to look at those, but I want to look at these options that are down here closer to the at the money. So when I took this screenshot, the market had actually sold off quite a bit from when I did this strategy, but I did it when I was setting it up for the 830s. So let's just go to that. It was trading around, it was trading right around 825, 824 when I put this trade on. So I did the 830 calls, and if you did this and looked at those 830 calls, you can see those are 51 deltas. And then if you go straight across to the puts, you can see those are 49 deltas, right? So 51 and 49 makes that the 100 deltas. Not a strategy for the IRA. You're right. As a matter of fact, if you're doing this in an IRA, what I would do is go out there and buy a call that's quite a bit higher, usually maybe a 5 or a 10 delta call. And that defines the risk. Now, the IRA is going to make you put up a lot more margin for that short. But if you do the long call up there at a 5 or a 10 delta, then it actually doesn't make it a red flag for you in an IRA. Now, it doesn't really limit your risk. I would never wait and hold on to this short strategy to my defined risk long call, right? I'm not going to let that be my stop. It's just basically to get around the rules of an IRA. Does that make sense? Does that make sense for you? If you just define that risk, go out to about a 5 delta. You're welcome. All right. So we want to try and do this for the price where the underlying is doing. And like I said, yesterday was crazy. It was almost as crazy today in this market. But basically, to get our break even, if you're doing it for a debit, you have to subtract the debit. So my break even on this is 824, 22 or 12, 824.12. So that was right around where the underlying was trading. I think it was actually trading slightly lower than where that is. And you can do that when you're building the strategy. Now, you guys remember, if you were around for if you've watched the one on the risk reversal, I told you that you always wanted to do the risk reversal for a credit, because that gets your break even much higher. If you're doing it for debit, your break even's well below where you're at on this one. You would have to have a massive sell out on the bearish risk reversal. So you always want to do that for a credit. With this one, I almost always want to do it for a debit. It ends up being the same thing, folks. You are going to be, the margin in your account is what is coming out, really, okay? So although I'm doing this for a debit, what it does is it allows my puts to be in the money and my calls to be out of the money just slightly. So it allows you to not worry about that short call going in the money. Not that 72 days out, most people are not, even if that short call was in the money, are not going to do the assignment process, all right? They're just not going to. Inside of 9 days, that's where you would have to be worrying about it. But I tried to set it up where it's just slightly out, build it for about 100 deltas. My puts are going to have a higher delta number than my calls, because those puts are going to be slightly in the money. Does that make sense? So here, let's just do since that one got messed up a little bit, let's go look at this Apple. So for instance, if I had a trade in Apple, let's just say I looked at this as a bearish movement, all right? I'm not saying that this was bearish in Apple at all. That green candle kind of throws me a little bit for that one. But if I were to go over to the option montage, actually, and do this it's trading 140, or 143. So I'd go the ones that are slightly in the money. You can see it's a negative 52 delta. If I buy that, I'm buying negative deltas, that's negative. And then I go over here to the calls and I sell those. Now I just sold positive deltas, negative 48 plus negative 52 is negative 100 deltas. All right. So now if I go down and I build this out, where I go and confirm it, it is basically bringing up $3,500 as the buying power effect. That's the margin I would have to put up for doing a one lot in the options. Now, keep in mind, for some of you newer traders, one option contract is equivalent to 100 of the underlying. So when I was talking about the assignment, like, would you want to buy that stock at 105? And if you bought a 105 call, you would be buying 100 of the underlying, okay? So every one lot in the options is equivalent to 100 of the underlying, all right? So this one lot is equivalent to under the underlying, and it will act just like if I own the stock. So if I do the one lot, it's 3,500. But what if I went up here and just sold the stock? Why is it? Oh, it's because it's. I'm like, why is it giving me 10? It's not. It's 100. And I confirm it, 7,000. So twice as expensive, and that's not even including the maintenance and the borrowing costs and all of that stuff that goes into shorting a stock. So you can see just the margin itself, and the same thing goes if you build this for a synthetic long, folks. If you are doing this in a portfolio that I was saying you needed to hedge and build it out, well, you build this out as a synthetic long this way. You buy the call, sell the puts, and we could see that if I did this as a one lot here as well, it's going to be that same $3,500 here. But if I go out and I buy the underlying 100 times, how much is that going to cost me? 7,000, right? So it's going to cost me a lot less. That's why I was talking about if you're in a trading account that has less than 100,000, especially if it's less than 50,000 or something like that, using synthetics might be a better opportunity for you, because you can create a much more diversified portfolio with the same amount of money, right? Does that make sense? So you're not getting a dividend, but it will act dollar for dollar like the underlying. So if you're looking at it for capital gains that way, that would be the way to play that. Okay. All right. Analyze the trade is what I was going to do here. So let's just, let me pull up this platform again. Where is it? So Apple, going back to this trade, 70 days. I'm just going to sell the puts, buy the calls. We got 100 deltas, make it a one lot so we can see what it would be equivalent to what the underlying is doing, right? Analyze the trade. And if we blow this up, you can see there's like a purple and a blue line in there. If you can see that purple and blue line crossing over, the purple line is for the stock. The blue line is what my strategy is doing. Exactly the same thing. Now, over a very long period of time, like this goes way in my favor, let's say, it stops being exactly 100 deltas, all right? You can see that my negative deltas gets a little bit paired away, because remember, as those puts, go way in the money, it approaches one, but we never really can achieve that one when it's way deep in the money. It's going to be very close, but it's just not going to be exact. And that's a bit of a drawback, but that's, we're talking hundreds and hundreds of dollars down before that really starts making a noticeable difference there. Okay. But keep in mind, when you're trying to get out of this trade, get out when you're set up. In my case, this one, in my Nvidia, I'm in on a confirmation like this. On this day, if I got in here, my out is when we basically pierce that top of the previous day, okay? Today, I got another move, right? My out is above the previous day, right? My out is above the previous day. That is on a change in direction, right? I'm writing this out, but when I see the change and move, that's when I'm starting to pull out of this, all right? So out on a loser above the previous day. Look at that. It's almost like a trailing stop in a sense. But your max profit is that underlying goes to zero, right? If you sold or shorted an underlying, how much money can you make? Well, if it goes to zero, it can't go negative, right? And if you were synthetically long, then your profit is unlimited to the upside. Max loss on a synthetic short is unlimited. This can go to 1 million, right? So just know your risk to the upside. Know where you're getting out. I would be saying I'm out above the previous day's settlement. Write that stuff down. It'll help you stay mechanical, folks. That's something I do. As a matter of fact, I've got all kinds of notes, right? I'm writing them down, why I got in, why I got out, making small little notes there. So I have data going forward, not only to prove my thesis being correct, but also keeping my powder dry. If I go back and look at it, I got in for this reason, that reason, this, the underlying was doing this at the time, and I have that, I can go back and refresh my memory and keep myself a little bit calm. All right. So get out from the previous day's high. Your break even, something to note when you're doing a break even, it is just like the risk reversal. Your break even is your strike price minus the debit. All right. Or your strike, if you're doing it, plus the credit. All right. So like mine, I was looking at those 830s. I did mine for a debit. So $5 and I think it was 88 cents or something, right? So that put my break even at 24.12. Right. That was what I wanted to do. Let's go back to this again. I wanted to show you this as an example. So I did this as a credit, right? So actually, and that's on the, I want to do this as the put. So I want to buy the puts, sell the calls, and I'm paying a debit. So what did I say? A debit minus what the underlying is doing is where our break even is. So I basically have the, or minus the strike. So I've got the 140 strike minus $1.80, right? So basically that puts me at 143.20. All right. So I would be selling at 143.20. It is right there where the underlying is trading. So when you're building this out, know that your break even should be in and around where the underlying is trading. More times than not, though, even like today when I was trying to get these screenshots for that Nvidia trade, when I got in at 24.12, 824.12, it was trading 823-ish in change. All right. So I was selling my option strategy above where the underlying was currently trading. And a lot of times you will see that happen with these strategies where you will be buying slightly lower than where the underlying is trading or selling those slightly higher. You'll be maybe playing around with those. Hello, Mac. You'll be playing around with those a little bit, but try and build it out where you are shorting above where the underlying is trading. Your break even is above where the underlying is trading on a short, or you're buying a synthetic long below where that underlying is currently trading. Okay. Don't be selling it to $1 or two below, right? That doesn't make sense. Make sure you build it out, put it in there around where the underlying is trading, and let the algos and all these market makers match prices and get you clocked in, because it will happen. You'll get very close to where that underlying is trading, if not better. All right, any other questions before we get moving on? All right. All right, well, without further ado then, let's get on with it. All right, folks. This is your offer for today. It is basically the Wolfman options course. I'll be throwing it over there in the link here shortly for you, that you guys will be able to have a hot link for it. If you are watching this on tape delay, there'll be a link down there at the bottom that you can go in and click on that rather easily. So you can take advantage of that. Sorry, I'm trying to copy this link and see if I can get this figured out really quick before we get out of here. Thought it was, and I want to find StreamYard. I'll throw it in the link here for you so you can have the hot link. All right, so there it is. I think the link's over there. Basically, you guys are getting, this is well over 15 hours of content. We're going to be talking about rising interest rates. Yeah, interest rates started going down, but is this inflation transitory? We've been talking about that I don't know how long. And spotting trades using market profile. Folks, if you aren't using market profile, it is the psychology of the market. It tells you when things are overbought and when oversold, and it tells you when it's just happy dory, all right? It's kind of like the three little bears, all right? The three bears. too hot, too cold, and just right. Also, quick understanding when, where, and why we're trading options, all kinds of new stuff in there that you guys can take advantage of. So please make sure you click on that link. It's discounted massively. Like if you were to set up a strategy, listen, if you're out there buying and selling stocks, I just saved you easily $36 in your margin. You're going to be able to double what you're trading there. All right. Somebody did the happy face out there. That's funny. All right. So take advantage of that. Like I said, the link is over there on the side. I'll be circling back around to make sure everybody's got their questions, comments, and everything else figured out. Also, make sure you check out the risk disclaimer. But here is another screenshot of the page that you'll be landing on and gives you a little bit more color as to everything that's happening. You guys are going to need to start thinking about hedging interest rates in a portfolio. You got plenty of time to start learning about that. Fun ones in here also, history of options. That's a really great one. Talk about Aristotle and his stories of the first person to create options. So check that stuff out. But like I said, here is that page. Take advantage of that. That's all I got for you folks. Other than hit that subscribe button down there at the bottom. Make sure you get that bell so that you guys get access to this. We'll get a notification out to you. So when I kind of shoot from the hip and just hit live, you guys can go on there and see what trades I'm talking about immediately. Also, comments over there at the side. I'll be circling back around for you folks. Make sure you're clear of concept. And finally, either smash that or take that. All right, take it easy. Bye for now.